Welcome to what is now episode 3 of Tax Break. I'm Steve Dixon, and I'm here with my colleague Lauren Pons. We're happy you've joined us for another episode, and we're going to dive right in. On this episode, we're going to return to the beat, a topic we addressed in episode 2. This time, we're going to address an aspect in the proposed regulations that were released in December 2019, the taxpayer's ability to forego deductions.
So, Steve, so far we focused on whether some transfers of funds constitute base erosion payments, but really that's only part of the story, right? So you can have as many base erosion payments as you want, but there's this thing called the threshold, and that's what really matters. So this 3% or 2% threshold that everyone keeps talking about, what does that mean? And what can we do to maybe never trip that threshold in the first place?
Well, in order to trigger the beat, right? In order to count in the numerator in this 3% calculation, we're just going to use 3. I know there's a 2,
we know there's
we'll
a 2, but
we'll just stick with the 3.
Yes.
And so setting aside some other unique circumstances, the taxpayer has, what we're measuring are base erosion tax benefits. Mm-hmm. Right, which are themselves necessarily, they only flow from base erosion tax payments,
right,
which is what we were just discussing. So in order to have a tax benefit, the taxpayer has to take a deduction for the base erosion payment.
So the benefit is actually what hits the return.
That's
what are
right.
you taking against your U.S. income?
That's right.
Okay.
So this raises an obvious question. So for a taxpayer that's close to the 3% threshold, can the taxpayer just forego deductions that it would otherwise take in order to lower its numerator and stay below the threshold? And so, yeah, go ahead.
That just sounds very novel to me. I don't know. Usually you're thinking about all the deductions you can actually take, but the beat we know is so tough on taxpayers that the idea that you forego a deduction being an attractive proposition is kind of a new space to be in, isn't it?
I think that's right. I think that for the most part, taxpayers are dead set on maximizing deductions. I mean, I think there are certain circumstances where they may be indifferent to deductions. Mm-hmm. Back when we had an AMT, there might be a reason why you might not worry about calculating your deductions. But it's certainly a novel concept. But if you are close to what we would call the cliff, the 3% threshold, it's entirely reasonable to start thinking about the relative economic benefits of taking the deduction versus crossing the threshold.
Right. And so you talk about this cliff. Can you describe that a little bit more? Am I getting ahead of you?
No, I mean, I think that this cliff means, look, either you're above the 3% threshold, in which case you're paying the beat, or you're below the 3% threshold, in which case you are not. And the difference can be significant depending on the size of your potential beat liability. And foregoing a relatively small deduction is now my understanding is that this is not the notion that you could waive deductions to get out of the beat is irrelevant to some taxpayers. Mm-hmm. They'd be waiving so many deductions that it's just not economic. Mm-hmm. That said, for taxpayers that are close to the 3% threshold, it does seem likely that they would be in a position to evaluate, and we'll talk a little bit later about the sort of game theory about exactly how you would decide which deductions you might waive and when you would make that decision.
Right. But essentially, you can have like 1 penny push you over into beat liability.
That would be a risky strategy, but
hence the cliff, right?
Hence
it just
the cliff.
takes say $1.
That's right.
Of tax.
That's right. So there's an argument here that the statute isn't quite so clear about whether you can do this. Mm-hmm. And the reason why is this sort of traditional distinction between allowed deductions and allowable deductions.
Right,
so the way this historically cuts out is allowed deductions are the ones that you actually take, and the IRS lets you take them. And allowable deductions are the ones that you theoretically could take. Mm-hmm. And unfortunately, in its first draft, right, in its existing draft, the statute actually uses both terms.
Right.
So it talks about, so if it had unequivocally referred to allowable deductions, then you might decide that this notion of foregoing deductions in order to stay away from the cliff was a viable option. But so there might be an argument that taxpayers could not waive their way out of it. I actually don't think that argument works for reasons that actually implicate some of the things that we talked about earlier. But first, we should note that the Section 59A actually uses both terms. So both the terms allowed and the term allowable appear in the statute language itself.
So would that be ambiguity?
One could argue that would be an ambiguity, and one that Treasury then would have an implicit grant of authority to step in and regulate.
Opens the door, so to speak.
But let's talk about the possibility that you have to count all allowable deductions, all possible deductions,
whether or not actually taken.
Okay. I think that's hard to reconcile with the BEAT and its overall approach. So, which appears to be, and I think you would agree with this, which appears to be to discourage taxpayers from making a lot of foreign payments for which they can take a deduction.
Right. That's our base erosion. That's our de jure base erosion, right?
That's right. And it's a narrower notion of base erosion, right? I mean, you can picture a broader notion of base erosion that has to do with sort of where your assets are and where your value generating activities are, and this sort of, bring jobs back to the US kind of notion of base erosion. But it's pretty clear from the way that 59A works that they weren't aimed at that broader notion of base erosion. In fact, what they were aimed at was the notion that you're paying foreign affiliates and getting a deduction for it.
It's a very basic definition of base erosion, very formulaic.
Right. And in fact, we see that in particular, one of the places that I think commentators have pointed this out is the notion that outbound payments made for amortizable or depreciable property that's then brought back to the U.S. is itself treated as a base erosion payment. So the payment for that property is treated as a base erosion payment. And there's an argument under that broader notion of base erosion that, hey, what's the problem with this? You are paying a foreign affiliate, but then you're bringing back an asset that's generating amortization or depreciation deductions because it's doing work in the U.S.
Right.
And because it's actually earning income and generating value here in the U.S., which is something that we ought to want to encourage. But the BEAT actually sort of takes the opposite tack and says, no, you're just bringing more deductions back to the U.S. We want to discourage you from doing so.
Right, you're importing deductions, and that, we should note that the final regs did soften the original rule a little bit in response to taxpayers' comments that this was frustrating the purpose of TCJA, which was to bring valuable IP back to the U.S.
Right.
So there's been a softening, but in general, it's true. That's the rationale behind that rule, that a payment includes a depreciation or amortization deduction.
And then also, if you think about it in terms of like the broader policy goals.
Mm-hmm.
So on the one hand, it's one thing to ask taxpayers to radically restructure their operations in order to make sure that there are more payments flowing into the U.S. than there are flowing out of the U.S. That's kind of an abstract goal, and one that would be hard for many taxpayers to do given their business model.
Right. It's a global world. Like, we're not, it's not just, I think a lot of times people think, oh, it's the U.S. and another foreign entity. It's many other foreign entities, and sometimes the payments are going foreign to foreign, U.S. to foreign, foreign to U.S., but it's not just one-to-one back and forth.
That's right. But what does seem like a reasonable policy goal, rather than asking taxpayers to sort of restructure all their flows, it does seem like a reasonable policy goal to say we want to begin to diminish the size and number of deductions that you are taking for payments made to foreign affiliates. That seems like a doable and achievable, and frankly, when we consider it in this context of waiver, a sort of a reasonable goal to say, well, yes, you are making a lot of payments to this foreign affiliate, but you could get out of the BEAT by not deducting all of those amounts.
By paying more regular U.S. tax. That's fine.
So it makes more. So I think in the context of the BEAT, this is all a long way of saying in the context of the BEAT, I think it makes more sense to conclude that Congress intended to include only allowed deductions. And now we know, after the regs that came out in December of last year, we know that Treasury basically agrees. They take the position that taxpayers can waive deductions to get below the 3% threshold.
Right. And doesn't that make sense when you think about a base erosion tax benefit? So allowable is a universe of deductions, but until you've actually taken that deduction, you haven't enjoyed any benefit.
That's right. That's right. So what did they say? They said, and they have sort of a quite a kicker here. They say these proposed regs provide that a taxpayer may forego a deduction, and that these foregone deductions will not be treated as a base erosion tax benefit if the taxpayer waives the deduction for all U.S. federal income tax purposes. And then the big kicker at the end of this is sort of the record scratch moment, is where they say, and follows specified procedures.
Oh.
So the idea that we're moving from a universe when taxpayers could forego deductions without really saying anything to the IRS about the deductions they were not taking at the time, to a place where they are going to have to report the deductions that they're foregoing.
So it gives the service a little bit of a peek into the magnitude of deductions you might have been able to take, and just more information. Whereas before, as long as you didn't take it, it wasn't a known number. Yes.
It didn't matter. And we all know, I mean, we've all seen this in all kinds of circumstances where corporate taxpayers, that frankly, they're saving themselves some resources because they realize we've capped out on a particular kind of loss, or we're going to be in the AMT anyway, so we don't have to do this. We don't have to do the sharp pencil math here.
Yep. We
can just say that it doesn't matter. This puts them in a different posture, especially if they're close to the threshold and relying on this to get them out of it. And in fact, the proposed regs go on to provide that the default assumption is that all of the taxpayer's allowable deductions are allowed deductions unless the taxpayer expressly waives to elect them.
Wait a minute. So isn't that kind of flipping the rule on its head? So you're back in the universe of allowable, because we're going to assume that everything is allowable, and we're going to assume that you take every deduction to which you are entitled.
I think that's right. And I think the way in which they have phrased this proposed regulation, and we're still in proposed regulatory form here, is something that taxpayers need to really consider, because this seems to me that it's worth comment. I mean, there are administrative burdens associated with this, but also it does flip the conclusion. I mean, if we think that the statute is more consistent with the notion that 59A counts only allowed deductions, this says, no, it counts all allowable deductions. You just need to tell us all the allowable ones so that we can, and then sort out the ones that you think are allowed from the ones that are just merely allowable.
Right. And so do you think Treasury did it this way? They used this phrasing because of the ambiguity in the statute? This was a way to reconcile the two and still come out to a place where we're going to expressly say that you can forego allowed deductions, but bring in this concept of allowable?
I don't know. I mean, I guess it's tricky to say sort of what they were thinking here.
Yeah,
I mean,
we don't know.
and I mean, look, you know, having spent my entire time in the private sector, so you can respond to this, but you know, I've always thought that Treasury and certainly the IRS take the perspective that that information is sort of ready at hand for taxpayers, that there aren't a lot of costs to collecting additional information. And that's clearly not the case. And taxpayers are going to need, I think in commenting on this reg, I think taxpayers need to sort of bring that to bear and talk about what it would take to assess the universe of allowable deductions, because that universe of allowable deductions for some taxpayers may be much broader than anything they've ever even considered before.
Right.
And to the extent that this reg is imposing some kind of additional requirement in order to waive deductions, you know, perhaps there's some way to shortcut that procedure to talk about deductions that you've taken in the past.
Like a history of taking these deductions, so that becomes your allowable universe, because what you take is what's actually, in practice, is actually what's allowable.
That's right.
Not what's possible, but what do you do?
That's right.
Yeah, I think, you know, Treasury certainly has administrability in mind when writing these rules, not only for the government, but also for taxpayers. I think the comments received probably reflect the reality of the cost burden, the time, man hours, woman hours to actually get this information. And so that's always an important data point for Treasury to have when it's crafting rules. But at this point, it remains to be seen how these will be finalized. But I do think that they take that information in and consider it and take it seriously.
Yeah, and one of the things that they have said expressly, and one of the concerns that I think is the sort of the fulcrum for leveraging this provision is that this concern that taxpayers might waive a deduction in 1 year and then recover it later by way of some sort of change in method, and they're worried about getting whipsawed,
which is a real concern.
It's a concern. It's a concern. But again, it belies our typical tax reporting procedures in pretty fundamental ways. So it might be tempting to sort of that this is a predicament that the taxpayers have brought on themselves, right? To blame taxpayers that, oh, well, you wanted some guidance and here you are. Here's the guidance. Guess what? Now you've got to tell us all your possible deductions and tell us which ones you're not taking. I think that's not quite fair. I wouldn't blame taxpayers in this regard. They just kind of came in with, I think, a pretty reasonable question that was prompted by what I mentioned earlier, that the statute uses the terms allowed and allowable. And taxpayers said, well, those terms do not mean the same thing.
Right.
Which one do you want us to implement? And so I think that it would be unfair to blame taxpayers for this. But at the heart of all of this is the question that I find the most interesting, which is, did we need this regulation at all? Did we need Treasury to give us a permission slip to waive deductions? And this goes back to something that we talked about in your portion, which is the notion that the BEAT is a gross basis tax, right? So you could have two taxpayers with the same economic income, and depending on how much of their payments are made to foreign affiliates and deducted, they could end up paying much more tax than a taxpayer with essentially the same economics overall, but a lower ratio of payments to foreign affiliates, right? And this has to do, obviously, mechanically speaking, and I don't want to bore our listeners with the mechanics, but it has to do with the disallowance of foreign tax credits in
Right.
computation.
So yeah, at first blush, people thought, well, I'm U.S. parented. I'm out of these rules. This is really for foreign parented companies, U.S. subs of foreign parented multinationals. The Senate Budget Committee report expressly states that this rule was to target those types of companies. And so I think at first blush, a lot of U.S. taxpayers were like, oh, we don't even have to worry about the BEAT, and to your point, they could have the same economic income, but because they don't have all these outbound deductible payments and the COGS exception, a lot of U.S. multinationals thought that they wouldn't have any BEAT liability. Now, foreign tax credit clawback changes that landscape significantly.
So I mean, and it seems to me like this is a place where the rubber really meets the road. So we always hear in litigation, right, that every time there's a deduction that's at issue, the government likes to say that deductions are a matter of legislative grace. So
right.
So if they are genuinely a matter of legislative grace, then it ought to be up to the taxpayer to decide whether or not to avail themselves of said grace.
Right.
Yeah. So if that's the case, why do we need a regulation at all? So another problem here is not just that does the reg need to exist at all, but there's also this weird sort of liability for missed deductions. Is it possible that the IRS is in a bizarre role reversal? The IRS is coming in for taxpayers who are close to the threshold and looking for deductions that the taxpayer should have waived in order to stay below the threshold, but did not because they missed it. It would be a really strange scenario.
Right. But in your earlier example of having kind of evidence of a pattern of taking deductions, this could work against the taxpayer if that becomes the standard, instead of a full audit of the universe of allowable deductions and then which ones did you actually take. If we look at past activity, and Taxpayer X has taken deduction Y for the last 10 years, somehow they miss it in year 11, perhaps the service could come in and say, we're going to make you take this deduction because you always have, and that's our test, instead of this, let's look at the universe and let's look at what you haven't taken. Is that a possibility?
I think it's entirely a possibility. I don't know if they say we'll make you take it, but they will say we're going to count it against you in computing your beat liability, right? So it could be a sort of a double jeopardy, if you will.
Well, this is interesting because in another context, there have been public statements by IRS officials talking about where in the range, in the interquartile range, taxpayers might find themselves. And in situations where the U.S. position was one where they didn't care that you were at the low end of the range, now they might push you up just for purposes of forcing taxpayers into the beat.
Right.
Which is another perverse result.
So I do want to talk a little bit about sort of because I think an interesting part here is, suppose you're close to the threshold. Mm-hmm. How and when do you decide which deductions to waive? So there are the proposed regs actually provide taxpayers with a pretty decent, I'd say generous window for deciding whether or not to waive. So you don't have to do it on your original return. You can do so on your original return. You can decide to not take particular deductions. But you could also do so by way of an amended return or even during examination. One thing I wanted to note here is that the preamble contemplates the same procedures that generally apply to affirmative tax return changes during an examination will apply here. So you can wait until examination, but as we know now, there's new LB&I procedures. So if you want to make an informal claim or some informal change to your return position, exam requires you to do so within 30 days of the opening conference. So I actually think that that's something that taxpayers are going to need to test, because I think that as the examination proceeds, your calculation of what you need to get below that 3% threshold ought to change.
Will change, yeah.
And so I think that there's going to there will have to be a back and forth with exam and the taxpayer in terms of if you disallow particular deductions or if particular deductions are in dispute. What do I need to waive to get below the 3% threshold, assuming I'm close?
That sounds like a lot of sharp pencil math.
It does, and I do think there's some game theory here too, right? So you, how much do you tell the IRS about what you want to do to get under the 3% threshold? And what does waiving those deductions mean for financial reporting purposes, for your tax reserves? I think there are a lot of issues in play. I think it's going to be really hard for taxpayers to manage this. However, I think that if you are close to the 3% threshold, it's probably worth spending a lot of money on pencil sharpeners.
And pencils.
And pencils. One thing that taxpayers can't do during exam is retract a deduction waiver. So the IRS wants this to be sort of a strict lie. You waive it and it's gone forever, which I think gives taxpayers an incentive to wait as long as possible to waive deductions and to not be overeager on their return. I think there's a possibility that this has implications for different implications for cap taxpayers than it has for taxpayers under normal audit cycles. And I think that there's also going to be sort of a margin of error. So taxpayers, as we know, sort of the ultimate liability and the total of deductions is a constantly moving target.
Right.
So how safe is safe? How are you sure that you're below that 3% threshold? How close are you willing to cut it? So yes.
Well, knowing what I know about taxpayers and their transfer pricing, when they're not sure throughout the taxable year what is actually going. Like it's a constant adjustment. So I can't imagine that, we have some taxpayers who have told us they have beat monitors, right? And so they're constantly paying attention to these outbound deductible payments. But if your transfer pricing isn't necessarily set in stone, one might imagine that the number of actual outbound payments might not change, but the quantum of those payments taken together probably does change throughout the year.
And I would imagine that there are lots of taxpayers who are reevaluating their transfer pricing in light of the beat. Although
Exactly.
I know the IRS has come out and said some things that they expect taxpayers not to do that sort of thing, although they have built a massive and very formalistic apparatus here to penalize taxpayers who don't do just that.
Right. So, you're damned if you do, damned if you don't.
That's right. So those are our thoughts on the new BEAT regulations, proposed and final. So we have opened up an email address. It's
We have.
podcasts@milchev.com. That's podcasts plural at milchev.com. We welcome your feedback, especially praise. We also welcome the opportunity to talk about topics that you think are interesting, and certainly we have some future topics slated, and we'd like to have some guests from the firm, and I hope some guests from outside the firm.
Yes. So if you would like to be a guest, or you have topic ideas, or you want us to clarify something we've said here, or want to offer us a prompt to respond to, we are happy to do it. So use the email address. Write us.
Thanks, Lauren.
Thank you, Steve.